Singapore, a city-state often lauded for its economic prowess, strategic governance, and business-friendly environment, has been in the global spotlight for decades due to its rapid development and robust fiscal policies. But in recent years, many Singaporeans have been left wondering, if Singapore was so successful, why is it raising taxes on its own citizens? Over the past few years, we have seen a substantial increase in the goods and service tax rate, GST. From 2007 to 2022, the GST of Singapore stood at 7%, but a year later it rose to 8% on exactly January 1st, 2023. Then another increase to 9% on January 1st, 2024. That is an increase of 28.57% in just 2 years. This sharp adjustment in the goods and services tax has sparked discussions among Singaporeans and global observers alike, raising questions about the rationale behind these hikes and their implications for the broader economy and society. Moreover, what's even more surprising is the fact that, if we extend this graph right here, we get to see that Singapore's GST rates had been rising over the past decades, but it wasn't as fast as what we are seeing in the past 2 years. From 1994 to 2002, the rate was 3%, and it stayed at 3% for nearly a decade. It wasn't until January 1st, 2003, that the GST rate was raised to 4%, followed by another increase to 5% in 2004, and eventually 7% in 2007. These earlier increments were spaced out, except for 2003, which witnessed a rapid succession of changes over just 2 years. So, why is Singapore raising its GST rates? Well, before we dive deep into the reason and why Singapore has been raising them, it is first crucial to understand what GST is and how it functions in Singapore. Goods and Services Tax, GST, is a form of value-added tax, VAT. This means it is a consumption tax levied on the majority of goods and services sold domestically for consumption. For businesses that are registered under the GST system, they charge GST on their sales, output tax, and receive credits for the GST they pay on their purchases, input tax. The net amount is then paid to the government. In Singapore, GST is charged on local sales of most goods and services. Imported goods. Some imported digital services, more recently included as part of digital economy considerations. However, certain goods and services, such as financial services, the sale of residential properties, and export of goods, are exempt from GST. Over the years, revenues from GST have become one of the major contributors to the government's coffers, supporting a range of public expenditures. Now, let's talk about the reasons behind the increase. One of the most important reasons that Singapore needs to cater to is its aging population and healthcare cost. Singapore is widely known as among the fastest aging societies in Asia. Here's a graph on Singapore's median age, data that we collected from Our World in Data. Here, you can see that over the past decades, Singapore's median age has rapidly risen. But this data does not yet include the projections laid out by the source. So, let's extend it. Here, you can now see that projections for Singapore's median age are going to rise rapidly. By 2030, the median age would rise to over 39.1 years, from just 35.1 years in 2023. By 2040, it would rise further to over 44.9 years. Why this matters is simply because as the population ages, healthcare demands increase exponentially. Chronic diseases become more prevalent, demand for hospital beds and elder care facilities grows, and the burden on healthcare professionals surges. Singapore's government has a responsibility to improve and expand healthcare infrastructure, from building new hospitals to enhancing outpatient and nursing home services. These undertakings cost billions of dollars, and the trend is set to continue. Here's a graph on Singapore's current health expenditure per capita, current US dollars, data from the World Bank. Here, you can see that healthcare spending has tremendously risen. Back in 2000, it stood at just $792, but as of the latest data available for the year 2021, it rose to a massive $3,969. This is a reflection of the significant financial commitment required to meet the healthcare needs of a rapidly aging population. Beyond healthcare, Singapore invests heavily in infrastructure. Whether it's building new mass rapid transit (MRT) lines, upgrading existing transport systems, or creating new public housing developments under the Housing and Development Board (HDB), these projects represent long-term, large-scale investments. Many of these initiatives are crucial for maintaining Singapore's status as a global economic hub and a livable city. Here's a graph on Singapore's gross fixed capital formation, current US dollars, data from the World Bank. What this graph is about is the total value of Singapore's investments in long-term physical assets, such as infrastructure, housing, machinery, and equipment, expressed in current US dollars. Gross Fixed Capital Formation, GFCF, reflects the country's commitment to building and maintaining the critical infrastructure necessary for its economic growth and quality of life. Here you can see, just like healthcare spending, investments into long-term physical assets have rapidly increased. As a matter of fact, from 2014 to 2019, the investments have relatively stayed the same. But after the 2020 COVID-19 pandemic, it rose massively to over $111 billion as of the latest year available for 2023. These are no small amounts, and while they represent a mix of public and private sector investments, it is important to know that in Singapore, the government plays a pivotal role in driving and coordinating many of these investments. Additionally, social spending has been on the rise. The Singaporean government is focusing on enhancing programs that help lower-income and vulnerable groups. They have provided various initiatives like the Workfare Income Supplement and Silver Support Scheme aimed at reducing income inequality and providing a basic level of financial security for older Singaporeans. Just like infrastructure projects and healthcare spending, these require continuous funding. To understand all of these, it is essential to pull up the Singaporean budget from the Ministry of Finance of Singapore. Here's a table for the overall fiscal position. Here, you can see that the operating revenues of Singapore, which is basically how a country generates money, mostly from taxes, has steadily increased from 2017 to 2023. But if you take a look at the expenditures, it didn't really overshadow revenues. Hence, you can see that the primary balance was either at a surplus or a small deficit from 2017 to 2019. But since the COVID-19 pandemic in 2020, we have seen the primary deficit balloon massively. In 2020, it rose to over 18.9 billion Singaporean dollars, and further deficits are seen in coming years. But the good part of Singapore's budget is that a large part that helps cover it is the net investment return contribution, which, as you can see, it was only in 2020 that really saw a big deficit in overall fiscal position. This graph, in simpler terms, basically shows the increase of government spending. Here's a graph on the total expenditure by sector from the same years. Here, you can see the increase in investments into health, where the increase rose from $10.2 billion in 2017 to over $16.8 billion by 2023. Economic development also saw a big increase from $13.8 billion in 2017 to over $20.5 billion by 2023. These all cost a substantial amount of money, and they are definitely not cheap. If money is spent too much on them, it can cause deficits. To ensure that Singapore does not go into deficits and ensure that future costs are mitigated, the government's plan is to introduce higher taxes. And one of them is no other than the goods and service tax. But why specifically the GST, you ask? Well, the GST is a consumption tax that spreads the tax burden broadly across all residents and visitors. Unlike income tax, which targets only those earning above a certain threshold, the GST ensures that everyone contributes to public revenue based on their consumption. This makes it an effective tool for raising funds quickly and steadily, especially in a country like Singapore, which attracts a high volume of tourists and expatriates who also contribute through GST. Moreover, it is well known that Singapore actually has a very low GST rate, especially when we compare it to other high-income nations. Here's a graph on that matter. Here, you can see the difference in the GST rates between Singapore and many other advanced economies out there. One of the only few economies that has less, or doesn't even have a GST itself, is Hong Kong. Nevertheless, economies like the United Kingdom, France, and a long list of other economies have very high GST rates. Hence, Singapore increasing its GST rates from 7 to 9% may seem substantial, but it is competitively low when we compare it to many advanced economies out there. But, of course, it's higher than other similar economies like Hong Kong. Here's another graph on the value-added tax as a percentage of GDP, comparing Singapore to many other economies out there. Here, you can see just how low Singapore's taxes on consumption are compared to other economies. This figure is, in fact, known as one of the lowest amongst advanced economies. Even though we saw an increase in the GST rates from 5% in 2004 to 7% in 2007, the overall GST revenues as a percentage of GDP only increased minimally. Here's another table on the value-added taxes, but this time using a different unit of measure, using the national currency, the Singaporean dollar. Here you can see that the value-added tax revenue has rapidly increased. Hence, the reason why it did not reflect when we compare it to the GDP was because Singapore's GDP grew significantly during the same period. The rapid economic expansion effectively diluted the percentage contribution of GST revenue relative to the GDP, even as the absolute GST revenue in Singaporean dollars rose substantially. Now, you understand why raising GST taxes makes sense. Simply because it's a great way to generate revenue, and Singapore does not really have high rates. Raising them would just bring Singapore closer to global standards without burdening its economy excessively. Now, before we end the video, it is important to also understand that raising the GST is going to bring some problems. One problem would of course impact the prices of goods and services. As GST is a consumption tax, any increase directly raises the cost of goods and services for consumers. Let's illustrate this. Let's take the sample of a household that spends $1,000 monthly on taxable goods and services. If there was an increase of 2 percentage points, from 7% to 9%, this translates to an additional 20 Singapore dollars a month. On top of the 70 Singapore dollars they already pay in GST at 7%. That is about 240 Singapore dollars more per year. For higher income families, absolute spending on luxury items or discretionary goods is higher, so the GST amount will be correspondingly larger in dollar terms. That's just the simplistic view, of course, and it is much more complex than that, as it would also impact businesses. The good part of Singapore, however, is that while GST has increased, the Singaporean government has implemented several measures to mitigate the impact of the GST. They have announced the assurance package, initially set at $6.6 billion, and subsequently enhanced to over $10 billion to account for higher inflation and cost of living concerns. They also have the permanent GST voucher scheme that has been enhanced to provide continuous support beyond the assurance package. So, do you support the Singaporean government in raising the GST? But anyway, do let us know what you think.